Good evening, everybody, and thank you for taking the time to come and hear this webinar. I'm sitting here in Herzliya in Israel, trying to pretend everything's normal, but as you know, nothing is normal. I hope that you're safe and your loved ones are safe, and if they're busy serving the country, I hope they return home safe soon. On the subject of security matters, there's a small chance that there's a siren during this webinar. And since my back is facing the sea, I think that if the siren is in the first part of the webinar, we'll take a 6-minute break and come back. If it's in the latter part of the webinar, we'll just call it a day and you can email any questions that you may have. I don't think we can come back for a couple of minutes at the end. Anyway, hopefully that won't be an issue. All right. My presentation today has sort of three parts. One, we're going to talk about the market and what's happened and what you can expect when you receive your third quarter report. Some of you may have a good sense of what that number is already. So we're going to talk about what's happened in the market, both the third quarter and year to date. The second part of the presentation is to talk about the election. I'm going to focus on what I believe are the market reaction to the various scenarios. I'm not going to talk about the policy differences or the swing states or anything. I just want to talk about what I believe we're getting okay, guys, we're getting a notification of a siren. That's I'm going to have to pause this. You're going to have to pause this. We're literally getting missile notices. So we're going to pause. This is weird. Okay, we're going to pause and see what happens. Thank you. Right, that was exciting. As I said, there's a small chance of a siren. Then the siren happened and we had to go back. Now we're back. Let's see if I can get my train of thought back. Anyway, as I said, the three parts to this presentation: markets, election, and Israel. All right, let's kick off. Quite hard to concentrate, actually, but let's try anyway. Okay, taking a snapshot at what's happened this year. It's been a very positive year for equities. The S&P is up about 22%, Nasdaq's up about 21%. A lot of that has come from the mega cap companies. The mega cap companies are the very large ones that you're familiar with: Apple, Google, Facebook, Nvidia, and a lot of that performance has come from them. The rest of the market has not done so well. So I would say that from a valuation point of view, those mega cap companies are somewhere between expensive and very expensive. And all the other companies are somewhere between reasonable to cheap. So we have a bit of a mix within the index. It's not that all stocks are overvalued. The mega caps are a little bit expensive, not bubble territory by no means, but certainly expensive. And it's very difficult to avoid these companies. You want to be invested in them. You can't not be invested in them. It's very hard to time them. But they belong in the portfolio, so we need to be allocated. In terms of signals, Q3 was kind of interesting because we had the bond market signaling pessimism, and I'll show you in a second how it does that, and the stock market signaling optimism. We had a pretty aggressive sell-off in the last 2 weeks of July, first weeks of August, and a pretty quick recovery thereafter. We had some pretty strong economic data coming through, inflation coming down, unemployment was okay. So we had this economic data and stock market giving us some optimism, and the bond market telling us that something was wrong. So something had to give, and something did give only in October. And I'll show you in a little bit what that looked like graphically. And it turns out, based on what happened in October, that the bond market was a little bit too pessimistic in the third quarter. In September, the Fed, as you know, started its easing of its monetary policy. So that's reducing rates, tightening is increasing rates. And they started with a pretty big 0.5% reduction in the Fed funds, which is the overnight short-term rate. Most market participants, including us, didn't expect 0.5%. We expected a 0.25. I have a sneaky suspicion that there's some political influence there, surprising the market 2 months before an election, 6 weeks before an election. So a little bit of independence suspicion there. But either way, it's a positive sign for the market that the economy is strong enough, we can reduce rates, inflation's under control, and we survived the high interest rate period. Inflation, as I said, is the latest numbers are 2.2%, way down from the Corona years in 2022 and 21. And the target is 2%. So we're nearly at the target, inflation under control. That's another positive. And recession risk is significantly reduced compared to before, mainly by that big reduction in interest rates. Goldman Sachs even say that they always give a probability of a recession. Beginning of the year, it was like 35%. Now it's down to 15%, which is their long-term sort of neutral number. And the elections are upon us. We expected a bit more market volatility, but currently the market is not showing any major concern about the election. So we'll talk about that when we talk about the election. Okay, let's just review some of these indices so you can get a sense of what's happening in your portfolio. Remember, when I say equities, or S&P specifically, or only that part of your portfolio is comparable to that. You can't compare bond performance to equity performance. Clients do this quite often, and they expect us to switch between bonds and equities. That's not how this game works. You have an allocation to bonds, you have an allocation to equities. That's driven by your risk appetite, because bonds are more conservative than equities. And if you're going to create a benchmark, you need to make a composite. You need to take some of the equities, typically the MSCI World, some of the bonds. Could use the Barclays AGG, the Aggregate Bond Index, and you make a composite reflecting your asset allocation, and that's where you expect your portfolio to be, give or take. Okay. So as I said, S&P very strong at 22.8%, a decent quarter. The quarter started negative, about 5 or 10% negative, 5% negative in July, and recovered nicely. NASDAQ didn't recover as well, but it also had a positive quarter. MSCI World, which is about 58% USA. So you can see the rest of the world is also producing equity markets doing well. Interestingly, the Tel Aviv 125 had a very strong quarter. So 9% for the quarter, 10% year to date. That should give us some comfort as we deal with the missiles coming in. China's an interesting story. Those of you who followed my webinars over the years, there was a time where I was pro-China, and we had a small allocation because we knew we from a risk point of view, we kept the allocation small. And what we discovered was that it's heavily influenced by government policy. Our thinking was it's the second largest economy in the world. If you combine the Shanghai and Hong Kong stock markets, those are huge stock markets that you want in your portfolio somewhere. But policy became unmanageable, and we couldn't predict or have any insight into the Chinese policy, which is hugely influential on the market. So currently, China, in our view, is uninvestable, but it still had a strong performance year today. On the bond side, on the global bond side, there's some capital gains. You can see very strong third quarter results as rates come down. So we had a bit of a wobble along. We've had more bond volatility than we expected during the year, but now things have stabilized a bit, and the global bonds are doing okay. Israeli corporate bonds have had less volatility actually, but overall they're ticking on and they're doing what they should do. Okay, very important. Lots of green here, so investors made nice money this year. Forgive me for a second as I get a little bit technical. I know some of you don't like technical stuff, but this is important for us. When we manage your money, one of the things that we look at is the yield curve. And what we have here in front of us is the yield curve, sometimes referred to as the term structure of interest rates. The x-axis is time or maturity. So starting off with overnight, 1 month, 3 months, 6 months, 10-year, 20-year, 30-year. And the y-axis is rates, okay? So we can see basically this is the bond market, okay? This is a very important tool. Now, a lot of people say to me, in my role, looking after your money and leading the team that looks after your money, a lot of people are, what's the stock market doing today? I personally have a philosophical view of the stock market. I don't live and breathe it every single day. I understand the volatility that is expected from the stock market. Whereas the bond market, this particular thing, I spend much more attention on this than I do on what the S&P is doing. Okay, this is a much more interesting thing. Now, what you expect in the yield curve, you expect an upward sloping yield curve. That's called a normal yield curve because you want to be rewarded for time. If you buy a 30-year bond, you want to earn more than if a 20-year bond or a 10-year bond. So the longer you invest for, the more you expect to earn. So you expect this upward sloping yield curve. When 2022 came along and we had this post-corona inflation, the Ukraine invasion with energy prices flying through the roof, rapidly increased interest rates. So they pulled up the left-hand side of the graph, and the right-hand side of the graph stayed low. So we had an inverted yield curve. Now, that is one of the main signals for a recession. It's telling you something is wrong. This is one way the bond market's telling you, the world, that there's something wrong. It doesn't make sense that you earn more for the short term than you do for the long term. So when this happened in 2022, we read it and we had to decide if this was going to lead to a recession or if there's enough economic data to continue to allocating our money in the equities. We kept a full allocation to the S&P and to NASDAQ, and that was a very difficult decision, but we did it and it paid off very, very well. So I'm quite proud of that. So now, these three lines that you see here in front of you, the top line is the yield curve at the end of June 2024. The bottom line, the yellow line, is the yield curve at the end of September, okay? And the midline is the yield curve as of last week, just before Yom Kippur. So what you see, and when I said the bond market is giving you a negative signal, right? The bond market trading below, with the 10-year trading below 4%, this was telling us something is wrong. There's going to be, the bond market is telling us there's going to be a recession, or there's going to be real economic pain. Again, we had to make a decision on how to do it. We thought that it was overcooked, and it's now settled back above 4%. In my webinar in January and April and July, I said that the 10-year should remain range bound between 4 and 4.5 or 4.6, which it did. But when it went out of that range in September, August, late August, September, it was 3.78. We thought that was overcooked, and then it settled back down. So, and what we see here is, if on the latest graph and the September graph, you see a reestablishment of part of the curve. So that is the 2-year to the 10-year. Now, the short end, the Fed funds, that's a little bit too high. So we know that's coming down, but here we can see a reestablishment of the normal shape of a yield curve. What we want. We want to see this, these blue arrows pointing up. That's what we want to see. And we're now starting to see it for end of September, and last week. And that's a positive sign. Okay. Forgive me for the slightly technical presentation, but I think it's an important point. Okay. Some numbers behind that. As I said, you can see this is the 10th of October, 4.0, but at the 30th of September, it was 3.7, and in June, it was 4.4. So this is the bond volatility, and it's quite as an investor, it contributes quite a lot of volatility to your portfolio. So these numbers don't look very big to you, but from our point of view, they're quite substantial. Obviously, not as substantial as 2022, when interest rates shot up 5%. That hopefully I'll never see another year like that in my career. But this is quite a lot of bond volatility for one quarter. I guess that's the main conclusion. Here's the bottom. The second part of the table is the relative steepness of that inversion or normal, and you can see they're not big numbers. So there is an improvement there, but it's a very good sign for us to see some normalization of that yield curve. Okay, that's all I'm going to say about bonds. I hope it wasn't too technical. Moving on to the elections. Okay, so we know there's the US has separation of powers, the White House, House of Representatives, Senate, and all are up for grabs. Okay, our reading is that the Senate, there are 34 seats up for grabs. The mix of those seats is leaning Republican. So we think that the Senate is likely to go Republican. So I put a slightly higher probability when the Senate is Republican than when the Senate is Democrat. The House of Representatives is much harder to predict. It's much bigger, many more seats. It's been marginally Democratic of late, and we think who knows? Any scenario can happen. And then the White House, again, the US system with the electoral colleges and different ways of counting and different ways of whether illegals or non-citizens vote or not, we simply can't predict it. But the point I want to make from this summary of the scenarios, if it's a Republican clean sweep where the Republicans win the White House, the House of Representatives and the Senate, Generally, that's positive for the market. Why? Because they will extend the tax breaks. They will spend less on social services and healthcare. The scenario that we are a little bit worried about from a market point of view, also from an Israel point of view, but more from a market point of view, is a Democratic clean sweep. If the Democrats take all three, unlikely scenario, but that would be a negative scenario. Also, if the Democrats take the House and the Senate, which is a very low risk probability, then that also could be a negative from a market point of view. There's another scenario which is more likely than not, and that is the chaos scenario, okay? We had a taste of this in 2020 when Trump challenged the election results, and which led ultimately to the January 6th demonstration, whatever you want to call it, okay? So we had a taste of that. Now, the American system, the Americans, it's not a banana republic. Whatever challenge to the election results could happen or might happen, whatever challenge will happen, it will be sorted out. I do believe that. But there's a scenario where we don't know the outcome of the election for a number of days, weeks, possibly months. And that could be bad for the market. So it's not, given the situation, and one of the investment firms I follow, KKR, a very well-known, they produced this slide, which I copied across. It's a perfect storm for electoral chaos, okay? It's an extremely close race. How close? They say here, in the past 15 presidential elections since 1964, a candidate has led by more than 5 points in the national polling average for at least 3 weeks. In 2024, there hasn't been a case for a single day. So it's really, really close, according to CNN. But whatever, I don't know. All the elections that I've followed in the last 20 years, the polls are always misleading. You never know what the outcome is going to be. But we have a close race. We have all three houses up for grabs because the margins are so tight. We have no trusted arbiters, okay? There's no one has the respect of the Supreme Court when it comes to political matters. So that could be a major issue. Then we have AI and social media feeding the frenzy of disinformation, misinformation, false information. And there's a chance of a real challenge here. I mean, this chaos scenario is not an impossible scenario, but I do believe it will be sorted out. Just bear in mind that it could happen, and we may have a little bit of a wobble there. From an more philosophical point of view, taking a long-term view at the American market, elections generally don't matter that much. Okay, you're going to keep your equity allocation. You're going to ride out whatever volatility comes around that election. And at the end of the day, when you take a 10, 15, 20-year view, the election doesn't matter that much. Okay, so very difficult to sort of time and make active tactical decisions. But I think that this chaos scenario is definitely something to think about. Okay. I'm going to move on to Israel now. We've had a lot of questions in the registration about Israel for obvious reasons. And Q3, we saw a positive turn on possible war outcomes with the what do you want to call it, decapitation of Hezbollah leadership. And unfortunately, we've seen a rating downgrade as well. So I'm going to talk a little bit more about this rating downgrade and what does it mean. Banks will be now a rating downgrade means when you go to the market to raise money, whether you're a bank or the government, you're going to pay more for that money. Before the rating downgrade, Israeli government issued a dollar bond for $8 billion, and they're paid, I think, 6.1 or 6.2% for that bond. And the next time they go to the market, they may have to offer 6.4, 6.5, something like that. So that's how the rate, because the market wants to be compensated for the increased risk. The The risk of inflation after the war is still there. There's going to be a lot of spend just when please God, the war ends. That doesn't mean the economic problems end. Okay, there's going to be a lot of post-war spending, or in parallel to the military spending, there's going to be rebuilding the North, rebuilding the South. We think that there's going to be a huge change, a massive increase in military spending all over the world, especially in Israel. And we're going to be, so until we get control of the spending, it's going to put pressure on the Israeli government balance sheet, which is reflected in the exchange rate and in the bond market, okay? It's unlikely, therefore, that interest rates in shekels will come down too quickly. And I said this will put pressure on the shekel. And my view is, we're currently at like 375. The probability of 390 to the dollar is probably higher than 360, okay? Not hugely higher. We could hover at this level for a while, but there's a lot of pressure on that shekel for sure. How do we measure what are the main things we look at when we look at how Israel's doing in the war? And the first place to look is the budget deficit. So currently the budget deficit is 8.1%, okay, fast approaching 10%, and it could go higher. The target budget deficit, which was at the beginning of the year, was 6.6. So we've already exceeded that target, okay? Just to give some historical context for the budget deficit numbers, so COVID 2020, we hit 11.78%, so that was quite high. Comparing to other previous wars, and by the way, we struggled to find this on the internet, so we used Chat GDP to help us find it. And it was interesting, they gave us a pretty good answer. We asked, what was the budget deficit in the other wars that Israel fought? So in 1982, for example, 1982, 1983, in the first Lebanon War, the budget deficit got to 15%. In the 1973 and post-1973, 1974, the recovery, the budget deficit got to 30%, okay? Now, 30%, the Israeli economy today is much bigger, much more, much stronger in absolute and relative terms. If we get to 30% budget deficit, that's bad. I think we'll definitely get above 10. I can't see this thing ending anytime soon. And we're going to get to about 10%. Now, when the new leader comes in the White House, doesn't matter if it's Trump or Harris, I believe they're going to throw money at the problem to try to create a settlement, okay? If they throw money at the problem, the only difference between the two of them will be the conditions and who else gets money. But I think one of the ways in the new White House seat, there'll be pressure to sort of calm things down, I think. And that might help the budget deficit. Sorry, lost my train of thought there. It's very difficult to think about the war, actually. So, okay, so that's the budget deficit. The outlook is not great, okay? This is definitely not an easy time for Israel, and our balance sheet is weakening. Let's talk about the downgrade for a second, okay? I think there's some misunderstanding about what is a downgrade. Downgrade is just one rating agency's opinion on the creditworthiness of a country or a company, okay? So Moody's and S&P have both, they use a different terminology. So I've just chosen Moody's here, and they show that it's their opinion on the rating, and it's not daily. They don't update it every day. It's might be twice a year that they update it, unless there's something special happening, okay? Whereas the market price for the bonds is happening daily all the time. And I find that a more useful indicator of where we are in terms of credit worthiness than the rating. The rating is after the fact, so to speak, whereas the pricing of your bonds is much more relevant. So I chose 3 other countries with the same Moody's rating as Israel today, and that's Kazakhstan, Peru, and Uruguay. same rating. Israeli bonds currently are 5.8%. Okay, that means the market expects to earn 5.8% on an Israeli bond. Kazakhstan for the same rating, 4.8. Peru for the same rating, 5.3. And Uruguay for the same rating, 4.8. So you can see here that the market expects, all other things equal, the market expects further downgrading. Compared to other countries of the same rating, we're more expensive. The market is already telling us that there's going to be further downgrades, okay? So in a month, 2-3 months time, when you read about another rating downgrade, it's already priced in the bond market. And I think that's a very important point. Another important point is when this war eventually ends, it's unlikely that the rating will recover quickly. It takes years of the right stuff to improve your balance sheet, improve your outlook to the world. So we're going to go down a level later this year or early next year, and we're going to stay there until good news starts flowing through. Okay, so I think that that's an important point. Just to compare where Israel's bonds, if we follow that logic that bond prices or these rates is more important than the rating, then let's see where we stand in Israel versus other countries. Okay, so I've randomly chosen a bunch of countries here. And remember, this is the dollar debt, not the local currency debt. It's not shekel debt, this is dollar debt, okay? So Brazil has the same price as us, even though their rating is considerably worse than us. I think below investment grade is 3 levels lower than we currently are, okay? And that tells you that, that confirms what I'm saying, that the market expects Israel's rating to go down. Japan, rock solid A1, 4.3. So that establishes the range of a very strong economy and a less strong economy. Hungary, 5.4. Mexico, 5.8, same as us. Turkey, 7%. I personally think Turkey should be trading way higher than that, 9%, 10%, given what's going on there. But the market says Turkey is 7%. Colombia, also 7%. Chile, very strong at 4.8%. They're clearly doing some of the right things. I know there's some people on this call from South Africa, so just to put in some context, and South Africa doesn't have an exactly 10-year bond outstanding, so we took the 2032 and the 2041. The 2032 is 6.1%, only marginally more expensive than Israel, and 2041 is 7%. My personal view, you can think about it, would you rather buy, this is a question to the South Africans on this call, would you rather buy a South African government bond for 6.1% or an Israeli government bond for 5.8%? You can answer, I think I'd rather buy the Israel government bond during the war at 5.8. Okay, so that's that. My crystal ball for on condition there's no significant chaos effect from the election or a significant worsening of the geopolitical landscape, otherwise known as World War III. On condition that doesn't happen, I expect some more rate stability on the bond market. Remember, between 4 and 4.5 of the 10-year dollars. That'll be great for our bonds. We just collect the coupons and we'll be happy. And the equity market are expected to remain expensive for the mega caps, and it'll be flat or positive. I mean, it's very difficult to predict, but I don't see that we're in bubble territory or something like that. So in conclusion, I'm cautiously optimistic for the remainder of Q4 heading into Q5, heading into 2025. Okay. We received some questions on registration. Feel free to ask any questions now via the chat. But here's what you guys are asking, and I would like to point out this webinar is done for you. So these questions are important because we want to be able to at least address what you're thinking. Are Israeli startups hitting the wall? So this is a question about the availability of finance for Israeli startups and the flight of cash offshore. So the flight of cash offshore is by individuals who are taking money out of the country this money wasn't really lined up for startup investing. This is just people taking money out. So that's a separate thing. I would say as follows. We're not in the venture capital game. We don't invest in startups. We don't invest in VC funds even. But my view on it is as follows. I would say is local Israeli VC funds who raised money in the past are probably being more cautious about the types of companies they invest in. And overseas venture capital funds, at least some of them, are not investing in Israel as much as they did in the past because it's simply not worth the headache risk for them. Maybe they have important investors who are politically sensitive and don't want allocations to Israel. So some of those overseas venture capital funds. So the conclusion is, yes, there is less capital going around for startups, but not, I don't think it's critical as such, but yes, there's less startup. I'm more concerned about the large employers in Israel, the Intels, the Amdocs, the SAP, or Microsoft, those companies that employ people in Israel. I'm more concerned about that than I am about the startup world. This is an interesting question, okay? Given geopolitical uncertainties, would you consider gold as part of the portfolio? Now, I've discussed gold several times in the past at these webinars. You can make a tactical bet on gold. So a tactical bet would be a small part of your portfolio, 1 or 2%, maybe 3%. And you look at the price and you say, okay, this is worth a bet. While you hold gold, you don't get a dividend, you don't get a coupon, you don't get interest. It's very difficult to predict what moves the gold price. And maybe you'll make money, maybe not. So on a tactical basis, currently with gold at $2,600 an ounce, thereabouts, I would not be making a tactical bet on gold. But this question is about geopolitical uncertainties. So it's about the scenario where governments are collapsing, maybe finances are collapsing, where the world gets really, really scary. The academics call this an anti-fragile asset. They'll say, is there an asset that will perform when the whole world is falling apart? So if you're going to use gold for that type of protection, you need to own a lot of gold. You need to own 40, 50% gold. And what that does is it makes your portfolio completely unpredictable and very volatile. So we wouldn't be making a strategic allocation to gold to protect us against the end of world scenario. Not going to happen, certainly not. And we're not going to make a tactical bet on gold at $2,600 an ounce. Okay. When gold was at 1900, we had a discussion that said if gold got to 1700, then we'd make a tactical bet on gold. But it didn't happen, and it just went up to 2.6. We don't own gold. If we did, it would be a tiny part of the portfolio because of the nature of gold. You don't earn coupons, you don't earn interest, you don't earn dividends, and more importantly, you don't know what drives that performance. Next question. The next question is about US influence, and is there another currency other than dollar? And what is the investment approach to investing in the thesis that says the US is not what it used to be? Okay. I think this is an irrelevant question because there's no second place. Okay. The dollar is the reserve currency of the world. There's no second place currently. The gap between the dollar and any other currency, euro has fundamental weaknesses. It could fall apart tomorrow. The Chinese renminbi, no. Russia, no. Cryptocurrency, no. So there's no second place for reserve currency. It's dollar, dollar, or dollar. And I believe that for the rest of my career, the dollar is still going to lead the way. It's the strongest economy. It's the strongest democracy. Yes, there are challenges and yes, there are problems, but still is by far and away the strongest economy. So if you're going to run a dollar portfolio, then you need to be US orientated. If you want to run a shekel strategy or another strategy, that's a different story. But from a who's the strongest, there's no second place in my opinion. Okay, so the next one is the downgrade and the rates. I mentioned my view on that. European markets and stocks. There's a joke in our investment committee that says Europe is for holidays, not for investing. It's a bit cynical. We do watch it, but for a dollar investor, which most of our clients are, there's little appetite or rationale to invest in Europe. If we did, it would be tactical, whatever. There are some good companies, but there's none of the mega caps. There's none of the innovation and growth that there is in the US. So so Europe, it's something to think. If you're running a euro strategy, then yes, you need to be invested in the US, but I would prefer to have most of my equity exposure in the US. This next question is very interesting to me because it assumes that it says here, will the market ever crash, as it seems to just correct and bounce back quickly in recent decades? This is true, but this is what we expect, okay? We expect the markets to always bounce back. What we don't know is over how long. Let me give you a few examples. In 2008, from the peak of, say, July 2007 to the lowest point, which is about February, March 2009, that drop in US equity markets was almost 50%, okay? So very, very, very heavy drop. But by 2010, 2011, you'd fully recovered. So the market had come back. Since then, we haven't had a minus 50%. We've had a few minus 20s and a couple of minus 10s. And those recoveries have been very quick. But that's what we expect. We expect the US market, when the fundamentals are there, we expect the stock market to recover. Now, it depends which market. If you bought the Nikkei, the Japanese stock market in 1992, you had to wait about 25 years or longer for that to recover in yen, okay? So it's not a question of if it will recover, it's a question of when. It's just a question of time. And the fundamentals behind that will dictate that time. So the US fundamentals are strong, therefore the time to recover normally is short. And again, that leads us back to the USA. But from an investor mentality point of view, you should not expect a crash and then to stay there, because that's going to influence your decision. After the market crashes, you'll be tempted to sell. And that's the worst thing you could do. You need to sit there and wait for the recovery. The risk management is done before you allocate money to that asset class that could crash. Going into the end of 24, that's a bit, are there any sectors that I recommend? We've recently allocated to energy. We allocated 2% of the portfolio to energy. It was looking cheap to us. It's going well so far. So that's one thing we liked. It's a bit short to over a 3-month period. I don't think anything really, we never think in terms of 3 months. But our latest bet is on energy. Okay, how long can the Israeli economy hold in this wartime? A difficult question to answer. I showed you that relative to other countries, our bond market is okay. It's more expensive than it was, and further rating downgrades are expected, but the economy has got a lot of resilience in it. If this war goes on forever, there will be consequences, but hopefully that won't be the case. I don't think we're going to have a post First Lebanon War consequence of hyperinflation and all of that. I don't think that's going to happen. Investment in the Israeli market today, how risky? Well, I showed you compared to other countries where our bond market is. So take away the word Israel and you can see what the market thinks about our bonds. Okay, thank you very much, everybody. Apologies for the interruption with the siren. It's the first time I've ever had to recalibrate my concentration. If there are any further questions, please email us and reach out. We'll be happy to answer. And thank you all. And for those relevant, I wish you a Chag Sameach. And again, I want those hostages home and please safety for all your family and loved ones. Thank you very much for the time.